involve the calculations from Chapter 11. So that's going to be payroll. We're going to do a lot of calculating paychecks, and also notes payable. So those are the two things that I'm going to be going over in this lecture. So you do need to make sure to read the chapter, because I'm not covering everything in Chapter 11 in this video, only key calculations to give you some help with your homework. Okay, so the first thing that we're going to do is we're going to talk about how to calculate a paycheck. And you may already know how to do this. We're going to get into the details of what's included in your net pay. And the first thing we need to do is talk about gross pay. So all of your paychecks are going to start with what is gross pay. Now, gross pay can be made up of, if you were an hourly employee, it can be made up of your regular hourly rate. And let's just say in this example, it's $15. Okay, so you make a regular rate of $15. Now, if you're hourly, if you work overtime, and overtime is typically greater than 40 hours a week, you are going to make time and a half. So 1.5 times that 15 is actually $22.50 an hour that you'll make for any hours you work over 40. So when we are calculating the paycheck for an hourly employee, we need to make sure to only calculate regular rate for the first 40 hours and then use the overtime rate for anything over 40. For salary, there is no overtime, so we won't have to worry about hours worked for salary when we're calculating gross pay. Next, that's going to come out of our paycheck is going to be federal income tax withholding. We're going to calculate this using a withholding table, which I'll show you in a minute. Typically, a state will also have income taxes that come out of your paycheck. In Alabama, our state tax is 5%. Some states like Texas and Florida don't have a state income tax, and you wouldn't have to withhold any money if you live in those states. To simplify things, we're not going to be calculating state income tax withholding, but the method would be the same as federal in that each state has its own table that you would use to calculate withholding. We're also going to take out of our paycheck Social Security tax, which is 6%, and then Medicare tax, which we're going to say is 1.5%. The real numbers are a little bit different than this. This Medicare tax is really 1.45 in real life, but to make it easier, we're in your book and in your homework and in our notes, we're going to use 6% for Social Security tax and 1.5% for your Medicare. Oftentimes, these two taxes together are called FICA. So these are your employment taxes. What's interesting about these employment taxes is you're not the only one that's paying them on your paycheck. So you are going to pay your FICA taxes, and your employer is going to match this same amount. So you're going to pay in 7.5%, and your employer is going to pay in the same 7.5%. So the government's actually getting 15% of your pay, your gross pay, for every paycheck that you get. So after you subtract out all your taxes, you're going to have a net pay. And when you think about net pay, I want you to think that's what's on your paycheck. That's what actually is going to go in the bank. So the first thing we're going to do is we're going to practice calculating withholdings in a table. But to use the table, everybody gets allowances. Okay, and if you've ever started a job and they give you a W-4 or an A-4 to fill out on your very first day, what that form is for is we're trying to figure out how many allowances you get depending on how many kids you have, if you're married, if you both work. that kind of thing. And so to simplify things, I'm not going to give you a form to fill out. We're just going to say, I'm going to give you how much each allowance is worth. So let's say you have 2 allowances and they're worth $75 each. And different problems, I'll tell you how much the allowances are. We might use 60, we might use 80. So let's just say, based on your form you fill out, you have 2 allowances. So the only reason you use allowances is to plug your pay into this table. It does not actually come out of your check. This cash, these allowances are not withheld. So let's say you have $150 in allowances and your gross pay is $1,000. So we're going to take out $150 out of your gross pay. So to plug into the table, we're going to only plug in $850 of your paycheck into this table to figure out how much you're going to owe in federal income tax withholding. Okay? So the way that this table works is the government is the IRS is trying to make this easy for you, and we're trying to. We've got this these rates that are increasing. So you've got 10%, 15, 25. They're going up. As your pay is going up, your rate is going up. And so what you need to do is figure out which bracket are you in first. So each row in this table is a bracket. And you look at how much is my how much is my pay after I take out my allowances. So we're not taking out taxes yet. And you see that $850 is over $739, but not over $1,732. So what the IRS has done is they said the taxes on these previous 2 brackets, since we skipped ahead to number 3, is $95.95. So all the taxes on the first $739 has already been calculated for you. So all you have to do is calculate the taxes that are on the income over $739. So let's do that together. So we have a $850. Let's just start. $850 is what we're plugging into the table. And we've decided we are in this 3rd row here. So it says for any excess over $739, it's going to be 25% tax. So let's take out $739 because taxes on $739 have already been calculated for you. What's left over that hasn't had tax calculated is $111. So then we're going to use the 25% rate on that amount, and that comes out to $27.75. So that is the tax only on $111. We also need to add in what was the tax on the first $739. Well, that was given to you $95.95. So let's add it. So these 2 taxes together equal $123.70. So now we can start calculating our paycheck. First of all, our gross pay was $1,000. Now you don't take out your allowances here. I know we only plugged in $850 into the table, but that's the only reason we do that. We only calculate withholdings with that number, and then we don't actually take the $150 out of the check. We do, however, take your withholdings out of your check, so we're going to take out $123.70. And now we can calculate what is our Social Security. Well, our Social Security is going to be 6% of our gross pay, which is $60. And our Medicare tax is going to be 1.5% of our gross pay. So that's $15. So after you take out all your taxes, that's $801.30. So that's your net pay. Gross pay is $1,000. Net pay is $801.30. Let's do another example. Okay, so let's say in this example, we have gross pay is $2,500. Must be a salaried employee. It's given to us. They get $2,500 every paycheck. They have 2 allowances that are worth $75 each. How much is their net pay? Okay, so the first thing that we can do is say our gross pay is $2,500. Now we need to plug in a number into the table. Well, let's take out our allowances first before we plug into the table. We have 2 allowances again at $75 each. That is $150. So after we take out our allowances, that's $23.50 that we are going to plug into the table. Okay, so let's find where does $23.50 fit into the table? That is more or over $17.32 and under $35.66. So we're in this 28% bracket. Okay, so the tax has been calculated already on the first $17.32. So we're going to subtract out $17.32 first. So $23.50 minus $17.32, that's already been calculated on the tax. That's $618 that hasn't been calculated yet. No tax on that's been calculated yet. So we're going to use 28% on anything that's over that $17.32. So 28% times the excess is $178.04. So that's the tax on the $618. We now have to add in what was the tax on $17.32. It was given to you $344.20. So your total tax is $517.24. So we can plug that into our net paycheck. And then we can calculate our Social Security tax, which is 6% of the original gross pay of $2,500, which is $150. And 1.5% of the original gross pay is $37.50. So our net pay is $1795.26. Okay, so that we have now calculated. If I gave you this example number 1 and said what's gross pay, what's net pay, you would say gross pay is $2,500 and net pay is $1795. Now just remember, when you're answering this in your homework, if it's a fill in the blank, I'm going to give you the format. So I might say it needs to be in this format. So then your answer in the homework would actually be this number. Okay? Or this number. Just be paying attention in the homework as to what format I want your answers so that they don't get counted wrong, just for formatting. Okay, let's do another example. So here we have an hourly employee, so we're going to have to calculate gross pay first. This employee makes $42 an hour. They have 2 allowances, and they get time and a half, or overtime, for anything over 40 hours worked. And this week, or this paycheck, they worked 52 hours. So for the first 40, they're going to get $42 an hour, which is $16.80. And then now we have to calculate what's our overtime rate. So for the last 12 hours, we have to figure out what's our overhead rate. Well, our overhead rate is going to be our original 42 an hour times time and a half. So that would be $63 an hour. So 63 times the 12 hours is $7.56. So together, our gross pay is $24.36. So that's what we're going to put here. Now we need to take out our allowances before we plug this into the table. So if we take out $24.36 minus our allowances of $150, then what we plug into the table is $22.86. Okay, so we're going to plug $22.86 into the table, and we're going to see where are we. We are in this row. Okay, so anything over $17.32 has already been, or has not been calculated yet. So we're going to subtract $17.32, and $554 has not had tax added yet. So we're going to have to multiply that 554 times our 28% is 155.12. Well, now we have to include the tax on this $17.32 that hasn't been added yet, which is $344.20. So our total tax is $499.32. So that's what we take out of our check. 6% of our original gross pay is $146.16, and 1.5% of our original gross pay is $36.54. So our net pay is going to be $1753.98. So after you learn how to calculate a paycheck, we need to know how to put it in a journal entry. So here's some basic journal entries. There's 2 journal entries that go with recording payroll. The first is going to be what I like to call the paycheck entry. So the paycheck entry is essentially recording our net check. So you're just going to plug all of this information into your journal entry. So when you say wages expense, you're going to debit wages expense. When you see wages expense, I also want you to think that's gross pay. So if I were to ask you this same question here, number 2, and instead of saying what's gross pay, I asked you which wages expense, it would be the same answer. Wages expense equals gross pay. And then you're going to credit all of your taxes withheld and your net check. So federal withholding is going to be a credit of $499.32. Put in your Social Security and your Medicare. And what you're left with is a net check. So notice we're just recording that we owe all of these. These are all liabilities that we owe. So we are going to have to send the government is going to get all this money. We're going to have to turn around and write a check to the government. That's where cash will come out. That's another entry. And then this check is due to you. So this is what you're going to get. Wages payable is the same thing as net pay. So if I were to ask you the same example number 2, and the question was, what is wages payable? Your answer is the same as net pay. So that's your first entry. Your second entry is going to essentially match some of our entries. So wages payable and Medicare tax payable are going to be the same in both entries because, like I told you before, your employer has to match these taxes. Well, what we, the employee, don't have to pay is unemployment taxes. Only the employer is going to have to pay unemployment taxes. So you'll be given percentages, and just like your employment taxes, these are going to be calculated on gross pay. So let's say federal unemployment tax, that's FUTA, and state unemployment tax, and here's your percentages. So 0.8%, which is really 0.008 in your calculator, is going to be 0.008 times your gross pay. So that's $19.49. And the same with state unemployment tax. So you're going to put that in your calculator, 0.054 times gross pay, and that's going to be $131.54. So these are all of your payroll taxes payable. Together. So when doing the second entry, which is the payroll tax entry, you should do all your credits first, then total them up, and payroll tax expense is the total of all of those. So if I were to give you this same example, and the question was, what's payroll tax expense? You need to give me all of the taxes that the employer is responsible for, which is not only Social Security and Medicare, but also unemployment taxes. The employee is not responsible for unemployment taxes, only the employer. So I've given you an additional example to work through here with Matt making $32 an hour. He's an hourly employee. So look over this example and make sure that you can work through it. The last thing I want to discuss real quickly is notes payable. So notes payable is going to be the opposite or the other side of the entries that we made in Chapter 9. So in Chapter 9, we worked with notes receivable. And whenever we had a customer that wasn't paying us, we were going to take off their receivable and we put on a note. Well, in Chapter 11, we are that customer who is not paying. And so this is the customer's entry that they're going to have to make. So if we are not paying and our vendor says, well, this is going to have to be a note and you're going to have to pay interest, then we're going to remove our account payable that was a credit. So to remove it, we're going to debit that account. And we're going to put on a note payable. So now we have a note instead of an account payable. Over here in Chapter 9, whenever we calculated the interest, we took the interest rate for the number of days of the note. When we paid back the note, we removed it. So we had interest revenue that we were receiving and the note that was getting returned back, which was the principal. So together, we were receiving the cash from our customer. Over here in Chapter 11, we are the ones paying that cash. So the calculation is the same. So you could go back and see how you calculated interest, and we've got, let's say, it was $30. Well, we're going to remove the note payable when we pay it, and that interest portion is actually interest expense to us, the borrower. A new concept in this chapter is a discounted note. So if we have a discounted note, it's still going to be, we're still going to have an interest rate, which is called the discount rate, and the interest is going to be equal to the discount. So the upfront proceeds of a discounted note are actually less than face value. So let's look at an example. Let's say I have a $20,000 note. Well, what the bank is going to do is they're going to say you have 90 days to pay it, and the discount is 15%. So that means plug into your calculator 20,000 times 0.15. That's going to be $3,000. Well, $3,000 is the annual amount of interest. So we have to break it down into just 90 days of interest. So we're going to divide that by 360, just like we did in Chapter 9. And that's essentially $8.33 a day. 33333 times 90 days is 750. So 90 days of interest is 750. If this was actually a discounted note, what the bank would do is they'd say, the note is $20,000, but I'm only going to give you cash of $19,750. So you're essentially paying the interest up front. So in a discounted note, the proceeds or the cash that you receive is going to be your debit, and you're not going to get all of it. You're only going to get $19,250. But you still have to pay back at the end of 90 days all $20,000. So the difference in your journal entry is going to be interest expense, and that's going to be right up front. You're going to record that. And then when you repay it, the second entry will be crediting cash for the amount you paid back and removing the note. So that's the two entries for discounted notes. The big thing here is to recognize what's the difference between the note balance and the proceeds. Well, the difference is going to be the discount, which is really the interest. Okay? And then one other thing, just a reminder from Chapter 9, that when you're asked in your homework what is maturity value, that's going to be the face amount, like my first example, $1,000, plus whatever interest is on that note. So the maturity value of my original example was $1,030, which was the proceeds of the note and the interest. So that's just a reminder. Okay, so I know that was a long video. That was Chapter 11. And do let me know if you have questions, and good luck on your homework.